What's up, guys? Welcome back to Stock Talk. Some technical difficulties, but I think we're back in it. So again, if you missed that first part, stock futures are rising as investors monitor the war. And we also have the Fed policy move this week, so that'll be an interesting thing. Again, they're expected to raise the Fed fund rate by 1/4 percentage point, so about 25 basis points from zero, essentially, by Wednesday. So that'll have a lot of effect. It's not even so much the actual idea that they're raising the rates 25 basis points. I think we're really looking for comments out of Jerome Powell and the Fed as a whole to understand, okay, how many rate hikes are we going to have? If we have so many, what is the cadence of those rate hikes? What is that going to look like? So that'll be something that we'll have to look at this week and just keep guarded and look for any tail risk, So again, off of that news, let's take a look at the S&P sector ETFs. So we can see for this week that we are actually down on the S&P 500. No surprise there. Literally everything is down. I think the biggest loser out of all of these is going to be discretionary. So that's any type of like retail spending, retail consumer, someone that goes to the store and shops and they spend extra money that they don't have to spend. That's actually down the most, it looks like. The next big loser that I see on here that actually has the worst looking chart, that's going to be XLP. That's consumer staples. I think what's interesting there is we're now starting to price in more expensive food prices because we know that Russia has a lot of the wheat, they have a lot of the agriculture, and not so much that it even supplies the US, but maybe it supplies some of Europe. And so we're going to see price hikes there, price acceleration. So that'll be something that we have to keep our eyes on and understand, right? So be careful around those sectors. Is there room for it to come back? Yeah. But right now, let's be careful. Next big one we talked about with some of the guys in the group this morning is XLE. This is the energy ETF. So we know what's happened with energy. Absolute just insanity coming from the energy markets with the Russia crisis that we have. You can see that it's popped up here and now starting to come back and it's slowing down, kind of consolidating. Does it move back down? Yeah, maybe to 72.5. Will I add? I don't know. Why would I add on to something that's already up 120, 200% in the past 2 years? So given all that's happened in energy, I think it's time that if you're looking to get into energy now, I think there's just much better places to look. I think your mind's in the right idea. But why would you spend your money on that, right? When you're already up that much, go look for the beaten up quality, look for the beaten up sectors in the industries that are doing the best, that have the best stocks underlying, but maybe they've gotten beaten up the most. And that's where you're going to find these 100, 200% stocks. So those would be really something that we're touching on. We talk a lot about that in the Discord group. So make sure you guys that are watching, if you're not in that, be sure to check that out because there's a lot of conversation daily happening on that. So yeah, that's energy. That's my perspective on it. Again, this is opinion, not advice. Talk to your financial advisor. Next thing we're looking at, utilities has actually done pretty well. Will I be in utilities? I think it's the same thing as energy. Real estate's probably the one, in my opinion, and I'm going to move up the time frame here. Real estate's the one, in my opinion. This is, again, we're looking at 6-month charts. That really is consolidating. And when I say real estate, I'm not necessarily talking about home builders. I'm not talking about mortgage lenders. I'm talking about REITs, and specifically commercial REITs. Those seem to be the ones, for whatever reason, that are holding the most stability. And when we look historically, in this bottom right, they do the best in any rate hike environment. 2 months after, 3 months after the first rate hike, they're already up 12%, while financials and staples, they're lagging. Okay, so I think it makes sense that this right here, the real estate, is a place to be in, and I also want to be in technology coming after this rate hike, which we can talk more about that later if we have time. So that's just a quick update of where markets are, where the markets end. Let me know if you guys have questions on that, and be sure to throw in your questions into the chat too, so we can answer some of them. The next thing I want to look at is our MMAT. you know anything about it, this stock is basically what got our group even started in the first place. So we always have to look at it. We have a lot of guys that are still in it. So it's been a fun ride, definitely volatile. We traded the ups and the downs, and we have some just guys who've taken a hard line and are going to hold it no matter what. So we can see here that, you know, not really any material breakout over 2. I'd want to see a breakout over that 200 average. I'd want to see, you know, the stock 250. If I wanted to add big, I'd add big on it, right? I think we're just at a time where we're going to wait for these rate hikes. We're going to wait to see what happens. That's going to have a material impact on small cap tech and mid cap tech for that matter. And then once we have that down, I believe I saw the PE, the forward PE, so just the quality of the earnings or what the market's willing to pay for the earnings, is coming down on the small cap tech, or the Russell 2000 rather. And so when that happens, we're going to see a reversion up and see a mean reversion up into a higher level. So basically, all ships rise with the tide, and so as that happens, stocks like Meta are going to do great. So if you guys are in it, you know, definitely, you know, we talk about this one a lot. So good stuff there. Next one on the list, and this comes from my friend Joey, is going to be the airlines. So first, I'm going to look at the Jets ETF. This is the ETF, the index fund that contains all of the airliners, or the top airliners for the U.S. So let's get a good chart here. Okay, so 2020, obviously we know what happened there. Don't need to talk about that. Just slight movement up, you know, still very well below the pre-pandemic level of maybe 30, call it 32, and it's at 18, okay? So that's something there to keep in mind. Why is this down? Well, increasing fuel prices plays such a factor on airliners, even if you have the best airliner. Like I know we talked about Alaska Airlines, for instance. Love Alaska Airlines. I think it's a great company. They have great fundamentals, but in the short-term pain, they're going to get beaten up, chewed up, and just completely abused when you have increasing input cost, right? So I'm thinking, let's wait a minute. Let's get the gas prices to stabilize, give everyone a breath, jump back into the airlines. So let's look at ALK, and then I want to look at another one after that. And we can even see it here with the chart. I'm not a big fan of the death cross, as it's called, which is essentially the 50-day moving average. You can see this right here, and the 200-day moving average. So when the shorter term moving average crosses over the longer term moving average, what does that suggest? Well, what it suggests is that the short-term price action is greater, or it's increasing or declining versus the 200-day price action. And so when that happens, it's actually a very bearish signal, and it sends the market down. All of that to say is I'm only 50-50 if I think that's a great indicator. This is the reason why. You see how long it takes for us to get across right here. You guys can see that it takes that long for us to get one. Well, this took almost a year or 6 months worth of price action. So how long is that going to take for us to get that final signal? You know, so was the noise already over before we got the cross? That's the problem with technical analysis. It's a lagging indicator. It can only confirm our view that we had 3 months ago or 6 months ago. So all that to say, you know, I would maybe want to pick this up around the 40 level. We're at 48.82. Maybe in 44, 40 would be a good place. United Airlines, in my opinion, is probably the worst out of all the airliners, and not so much that it's a bad, you know, like if I fly, you know, somewhere, not that I avoid United necessarily. I think they have great customer service. They have a great business model. The problem, though, is that they are so indebted that a lot of their money actually goes to debt service, and it goes to paying those debts, and they can't return value to shareholders, right? We can see that here, like they're getting absolutely same thing, chewed up and swallowed. Would I short them? Maybe. I just feel like they're so beaten down. You know, what do you do? So I would stay out of the airlines with the exception of ALK. Put on a very small position. That way you don't forget about it. Cool. All right, and then one more that I wanted to touch on This is for all the people that are in transportation stocks, and namely things like Uber. Something to note, as fuel prices go up, with the exception of our oil prices being really low in the part of 2020, as fuel prices move up, what's actually happening to Uber, and this is the same thing with Lyft and same thing with DoorDash, all of these ride-sharing apps, these food delivery things, right? What's happening? Well, as the fuel price is going up, less and less drivers want to drive their vehicles to go work for the same amount of money, right? So meaning the pricing isn't necessarily dynamic. They're not going to make more if the fuel prices go up. So they have no marginal benefit to go ahead and to do that and to perform that job, that function. They're going to go find I don't want to say real job, but they're going to find something that's more steady, that can pay them, and that's in congruence with market conditions. So that's the problem with Uber and Lyft. Do with that as you want. If you want to short it, I think there's a lot of ways that you can do that. We'll be talking about that in the group in our Discord this week. Let's see. I think the ticker is YFT. Okay, cool. And this is the same thing. A lot more choppy, maybe a little bit easier to read. Let's get back to our weekly. The same exact thing. There might even be more downside with a company like Lyft. So that might be one to look at and to do some deep diving analysis on that. We have a lot of guys in the group that like to look at financials, so this would be a great one in my opinion to look at. Cool. So we went over Meta, we went over some of the airlines, went over Uber. We can check out XLF. I know a lot of people are going to be piling into XLF. This is the financials ETF. A lot of people are going to be piling in this thing. And here's the deal. If you missed the price action in 2020, why are you going to pay 100% more? Why are you going to pile yourself into it 2 years later when it's up 100%? That doesn't really make sense. And given the fact that everything right now with the rate hikes, we've only been talking about it for the past 3 or 4 months. So there's really no benefit in being in XLF unless you get a complete tail, a complete 5-6 standard deviation event where maybe they raise rates way more expected or an increased cadence. So there's really no benefit to holding XLF, to being in the financials. And I say that from a trading standpoint. We specialize in the 1 to 3, sometimes even the 6-month time frame. But if you're an investor, XLF might be nice to stabilize some of your portfolio to get the good sector exposure there. Cool. And so there's one thing that I wanted to talk about this week, and that's actually going to be real estate. And when I say real estate, again, I don't mean home builders. I don't mean your guy, your mom, your dad going out and getting a mortgage and buying their home. I'm talking about REITs. I'm talking about companies that have exposure to either the commercial side of the REIT or the logistics side. Those are the things that I find really interesting. So I'm going to look at the estimates for CCI. This is Crown Castle International. My friend Kyle brought this up and said they have some good stuff going for them, so I want to give them a look. I did some digging on them yesterday. We did a little dive into the financials. What I find pretty significant, and actually before we do this, let's look at the key stats because this can get confusing. Let's look at the key stats, guys. So total revenue growth, I see that really steady. 2021 revenue growth 8.6. 2022 revenue growth 8.48%. That's really consistent, right? And that's within what I would assume to be a pretty tight margin of error. So that's good to see. We want companies that are growing, right? Green and growing. Gross profit margin 70%. They do so. If they're increasing their profit margin in an inflationary environment, what does that tell me? They've got good management and they have a good handle on their expenses. And then for that matter, their revenues are growing too, right, to offset some of those expenses. EBITDA EBITDA to me, sometimes it matters. It matters when it does, and it doesn't matter when it doesn't, right? So what does that mean? Well, it really matters if you're investment banking and you're looking at stuff like that, or you're trying to write debt covenants in your really complex 10Ks. Other than that, well, it's not something that I think investors should use because it's not real money, right? Net income be a much better measure. But that being said, it matters when it matters, and it's going up. So, if they get anything, they get a little point for that one. Net income, again, I can see net income, like, look at this, 2017 net income 366. Okay. Net income, and this is just an estimate for 2022, net income estimate 1600. Okay, so what's the math on that? 8 times, 7 times, 6 times, 6 or 5 times. So that's pretty significant, though, that you're doing that in a matter of 5 years. That's pretty cool, right, that they're doing that. So I like to see that. Do they have debt? Well, of course they have debt because they are a REIT. Anything in real estate that's producing cash flow, people don't buy real estate with cash, they buy it with debt. It's a whole complex conversation, but the idea is that if I'm using debt, I can make more money. So that's why you'll always see a little bit higher debt numbers in real estate, as long as their cash is outpacing some of their liabilities and they're have a moderate to really good cash flow. Yeah, it's not that significant. So this is what I'm liking, though. I'm really liking the idea of the company, just getting an idea of the very simple fundamentals. Again, if I go to the estimates, I can see here cash flow per share. This is what makes me excited. 6.43 actual to 8.69 estimate. Again, this is 2022 and 2021. Estimates always come with a grain of salt, but I'll tell you that stocks will trade true to their estimates until they don't, especially in markets like this. And they're not trading true to their estimate. We'll talk about the price action in a moment. FFO, that's funds from operation. That's a REIT-specific metric. Again, increasing, adjusted, whatever that means, whatever the company is manipulating, it's going up. That's great. They're increasing the dividend they pay per share. That's awesome for us. Revenue increasing. Interest expense. Interest expense is going up slightly. Actually going from 2018 to 2022, going up slightly, but from 2021 to 2022, it's actually moving down. So we like that. We like that a lot. Return on equity, 4.58 to 21% in the past 4 years. Like, this is really significant growth, and the more I like it, I get excited about it, but I don't get emotional, right? We can cut our attachment, we can cut our position, we can get out of there anytime we want. That's the benefit of being liquid. That's the benefit of just being a almost robotic trader. You don't get attached to these things. You don't marry them. The next thing that I want to look at is going to be our chart. Again, if you guys take anything out of this, it's that real estate is really, it's really where money goes to hide, especially in America in tough times. And when it's cash flowing, everybody wants it, and it's pretty much always cash flowing. So we're going to look at the share pricing to EPS. This is earnings per share, just a measure of how much does the company make, or how much does the company actually keep at the end of the day. And then I'm going to adjust this to a quarterly number. And I'm going to try to get as much data as I can, because I really want to understand how does this trade on its EPS number. So I've got 5 years, I got 10 years. Let's see. So yeah, it trades pretty true to its EPS from 2016 to 2019. Looks like it was outpacing some of the growth. And we say it take the chart with a grain of salt, but we can get an idea of, okay, are earnings increasing and what's happening to the stock price. So we're not necessarily looking at, oh, this is below and this is above, because it doesn't work like that. We're really just looking for the trend between the two, trying to get an idea of the trend, okay? Let's see, so increasing EPS, this is on a quarterly basis, increasing EPS, increasing stock price, increasing EPS, increasing stock price, increasing EPS, stock price going lower. Okay, wow. So could this be an opportunity? I think so, given the fact that they have so much growth that's planned for the company. And when I say planned, I mean the analysts are really baking in some numbers and want to do some deep diving to figure out, are those numbers justified? But that's pretty cool, though, that we're seeing that we're going to get a lot of growth. We're going to get a lot of growth from the EPS with the share price popping up. That's good to see. And then the last thing that I like to do is I like to comp it to its peers. Now, I already did the work on this before, so I'm going to show you what I concluded. And really what I concluded is there's only one other company that I started to like out of all of these, besides CCI, and that was going to be this company called Equinix. I don't quite remember exactly what they do, but I remember their quants looked pretty attractive. Now, the one thing that stood out to me is their debt to equity. Basically, how much debt do they have versus how much money do they have with the shareholders, or how much equity they retain. We're going to see 134% to CCI's 321. Again, real estate, you're going to see high leverage numbers. Okay, CCI is above the debt to equity number. Okay, they're a little more liquid than Equinix, and they do make more per share technically, but I will say this: they're $693 and they're making $5.53 a share versus CCI 2.67 and they're making 173. So what's the number? What metric do we use to actually to measure that? And that's going to be something called the PE, the price to earnings ratio. And we can see that they are actually about 2 times cheaper. And I use cheap in a very arbitrary way here. Just on a PE number, they're actually at a 2 times discount to, or 50% discount to Equinix, their earnings are. So now we have to figure out, okay, why is the market willing to pay less for this number or for this ticker? Why are they willing to pay less? And why are they willing to pay more for Equinix? Those are the two things that we have to figure out. If we can come up with an idea that the market is just being irrational, remember the market can be irrational longer than you can stay solvent, we can determine that and we can understand the underlying business. Then we can put on smart trades and we can make a ton of money just by understanding the business, taking 10, 12 hours out of our week every week to learn these businesses, learn how to trade them, and keep learning and learning and learning and learning. Then we get an edge, right? Because we're not looking so much at building complex structured debt models. We're looking at the fundamentals of the business and just understanding basic psychology of the market, you know? So I'll leave you guys with that. That is something that was pretty significant to me in my findings, and I'm getting really excited for the real estate sector. I hope you guys are too. But before we end, again, if you're watching this either live or you're not on you're going to watch this on demand, be sure to click the link down below. That's going to be the link for our Discord, our Instagram group, all the cool stuff, all the ways to connect with us. Be sure to check those out. We have a ton of smart guys always talking about really cool ideas, and we'd love to have you guys there. So thanks, guys, and again, have a great and successful week.